On Sunday, the SNB were forced to intervene in the currency markets amid fears overwhelming demand for the Swiss franc may push the country towards a recession. Today, I'm joined down the line by Owens Thomsen for an economic update on Switzerland. Marie, some say the intervention was the first line of defence and the SNB will be keeping their fingers crossed that we don't see the worst case scenario play out. Now today we saw Switzerland's KOF reading slip to its lowest level in 3.5 years. So how concerned should the SNB be, and indeed investors?
Okay, so on the business cycle, I think clearly there has been a hit to the Swiss economy. That's pretty much what we're seeing in the numbers that you quote as well. But we are certainly not as concerned as many doomsayers, and we do not think that there's going to be a recession in Switzerland. That's for sure. But prior to January 15, we might have thought that Switzerland could have grown faster than Germany. And we have indeed changed our forecast so that we now see Switzerland not growing quite as fast as Germany.
Jordan declined to give details about the scale of the SNB's intervention or whether it was the first move by the bank in the forex markets since so-called Black Thursday. Following January 15th, the franc has soared in value, leading some to say we are back to square one. Did the cap removal work, and what is your outlook for Euro-Swiss franc?
Yeah, I mean, Switzerland is probably one of the world's absolutely best managed economies, and wherever we are in the business cycle, that still remains a fact. So the Swiss franc always has sort of a structural tendency to appreciate. So, and I think that that's really part of why it's so attractive. People would rather invest in a country that has a currency that appreciates rather than depreciates, after all. So I don't agree with those who think that somehow depreciating currencies is something to brag about. And a stronger exchange rate is actually fabulous for everybody in Switzerland who imports. And Swiss industry tends to be very import intensive. So the watch industry, for instance, imports almost everything. Pharmaceuticals, all these big Swiss companies are quite import intensive. So when the currency appreciates, their costs actually go down. And if we then imagine in a second leg that these products are in high demand in export markets, Swiss companies might actually be price setters in international markets. And some companies can in this way widen their profit margins when the currency strengthens. Now the problem obviously occurs when the currency appreciates too fast. And that we do know that the Swiss National Bank does not like. So if things get worse in Greece and there's more upward pressure on the currency, I would expect them to continue to intervene to try to prevent it from appreciating too much against the euro.
Tomorrow we'll see the Swiss Purchasing Managers Index for June. The May index came in stronger than expected and now stands just a fraction below the 50-point mark. Could this provide some positivity, or is data simply playing second fiddle to the market turbulence at present?
Arguably, I think you're right on that score, that Greece sort of tends to dominate people's minds. But on this particular number, I think, first of all, that we need to not obsess too much about the 50 mark. It's not like the economy is growing at 50.5 and somehow in recession when it's 49.5. The more important aspect of it is the direction, and it has, after all, as you said, picked up to 49.4 in May from a low of 47.3 in February. So we would expect the number to be stable or mildly positive, and that would comfort us in our view that things are not going so badly in Switzerland after all.
As you've said, Marie, it is all relative. So how do you see the Greek situation playing out?
Yes, I mean, we are among, I think, a majority to think that some kind of solution will be found. So if there's some sort of negotiated default, that doesn't automatically mean, obviously, that they have to leave the Eurozone. But if they go about things unilaterally, then that's where we can imagine possibly an exit. And of course, I do think that it would be really the worst case scenario for Greece in particular, but undoubtedly also bad for Europe, because it would be a big setback to the European construction. It's not like we need Greece, so to speak, because they only weigh 2% of Eurozone GDP, and the totality of Greek debt only weighs 3% of Eurozone total debt. So it's not really, I don't mean to be flippant, but in the Eurozone context, the Eurozone could easily pay for Greece, bail out their whole debt, and it wouldn't really be much of an issue. So they obviously need Europe more than Europe needs them. But nevertheless, the whole European construction project would definitely take a hit.
Marie, wonderful to have you on the show again. Thank you for your time. Viewers, as well as our ongoing coverage of the Greek debt talks, we have an exclusive interview on South Korea with Jessica Walker, as well as Tuesday's Commodities Corner. So please do keep clicking back. Goodbye for now.